So next part, third part, is about the passive bond management. One of uh, the way to use the duration in managing bond is so-called immunization. Immunization is the process strategy to match between the liability and the asset. So, for example, if the bank, um, any companies have some payment, like they have the obligation to pay, they want to match the the payment from the asset. So basically, they need to finance through the asset that matches the cash flow as um, the of the cash flow of the liability. So if you need to pay $100 next year, then you probably need to get another um, asset to generate $100 cash flow to pay that cash flow. So that's immunization. The problem is if the interest rate changes, then what happens is, because interest rate changes, we basically, the problem is if the interest rate changes, then the cash flow we will get from the asset may be different. So using the strategy so-called immunization, we can get covered. So that's basically major motivation of the immunization. So like many banks and the thrift institutions have natural mismatch between the maturity of the asset and the liability. For example, bank liabilities are the primary the deposit owed to customers. So it means that, well, the bank liabilities are deposit. If you go to bank and make a deposit, then you basically have the right to withdraw your money, right? So that's a liability for banks. This liability very short term, because usually bank savings can be withdrawn pretty short term immediately. So it must have low duration, right? So liability has low duration. Asset, however, largely have like commercials, consumer loans, mortgages, It means that the assets are long-term. Basically, the bank make money because they finance through short-term and then make a long-term loans. It's dangerous, however, because if everybody runs to the bank and try to, request their short-term money, like the liability for the banks, then bank doesn't have cash. So they need to have some serious plans to match these cash flows using the technique so-called immunizations. Well, similarly, the other institutions such as pension funds, the fund provide retirements. Well, the pension funds also have some liability to pay, and they also receive the assets, right? They usually have to pay every month, but their asset is quite long terms. So it generates some kinds of natural mismatch between the asset, the proceeds from the asset, and the liability to make a payments. So any institution with the future fixed payments should consider some strategy like the immunization, a reasonable risk management policy. Insurance company is also another part. So this is the example of the immunization. Insurance company can issue so-called guaranteed investment contract, so-called GIC, guaranteed investment contract. This example, they issue $10,000. GICs are effectively zero coupon bond issued by insurance company, which means that they need to pay back with certain yield after a certain time. If GIC has a 5-year maturity, okay, and if it guarantees, because it's a guaranteed investment contract, which means that it guaranteed certain investment interest. So if it guaranteed 8%, it means that this 10,000 should become 10,000 times 1 plus 0.08 to the fifth, right? Which is $14,693.28. So this insurance company should have 600 $93.28 in 5 years. So that's the obligation. That's the obligation. Suppose that this insurance company choose to fund these obligations. So they basically buy some asset using $10,000 coupon bond. So they want to finance this using $10,000 now bonds, 8% annual coupon bond. Okay. And with 6-year maturity and par bond. Okay, which means that the coupon rate 8% too, right? Now let's see the cash flow after 5 years. No. So this is the cash flow 5 years. So the A case rate remain at 8%. Now let's look at this. So each year, $800 cash flows are generated, right? Because $800 is the coupon, annual coupon. Now this $800 also will be reinvested at supposedly same YTM, 8%, okay? Then you have 4 years left for the first coupon, right? So the first coupon, you have 4 years. Second coupon, 3 years. Third coupon, 2 years. And fourth coupon, 1 year reinvested. Okay, and then the 5th year coupon also reinvest. I mean, it doesn't have to reinvest it because we're gonna sell these bonds and finance these $14,600, right? And 20 cents. So these are the money from the coupon. And then because it's self-par and it doesn't change, the interest rate doesn't change, it still remains as par, 10,000. So total, you can match the finance, like $14,693.20, exactly same. The reason is, in fact, we found this 8% annual coupon bond with par coupon rate 8%, yield 8%. If you calculate the duration, this coupon duration is actually 4.99 years, so about 5 years, which is exactly same as the one that we need to cover. Like we have 5-year maturity, 0 coupon bonds to match with coupon bond with duration equals to 5. So zero coupon bond duration is same as matrix, right? So the liability duration is 5, and also the asset duration is 5. It matches. So we can exactly generate same cash flow in 5 years, which is great, right? Now, let's look at the interest rate changes. Now, if interest rate drops by 1% point, so it becomes 7%. Now, because of that, we have two opposite impact. The first one is the price will increase. So price will be above the par value, which is above $10,000. But second, oppositely, the reinvestment rate also is going to be declined to 7%, which means that your coupon $800 will be reinvested at 7%, not 8%. So if you look at the second cases, let's look at that. The second case. Now this one, 7%. You see $800 are invested at 7% each year, right? These are the some of the coupons that you're gonna get. And then finally, you actually get more money because what? Because you will going to have the higher premium bonds because your yield is lower than coupon. If FMF is actually greater than the liability, $14,693.20, which means that we can successfully finance it even though the interest rate declines. Now let's look at the case that interest rate increases. So interest rate is increases by 1%, so it becomes 9%. 9%. Again, there are two impact. One, price declines because interest rate rise, right? So you're gonna have less money after all when you sell it. However, you're gonna probably have more money for reinvestment because you will going to reinvest your coupon at 9%. Let's look at that. So $800 now reinvested at 9, right? And then, so that's the sum of the coupons. And you're gonna have $9,908.26, which means you will get less money than 10,000, but because of this increase, in total, you're actually gonna get $14,696.02, which is greater than your obligation. So it also cover your obligation. So anyway, you can get covered. Which means that doesn't matter whether interest rate rise or lower, doesn't matter. The direction doesn't matter because you now find the security that exactly matches with the zero coupon bonds, your liability, the duration. You will get immunized. This is called immunization. This is called immunization. So if you look at the next graph, then what you can see is, your obligation is in 5 years, right? So the value of accumulated investment funds is this dot. And this solid line, the blue line, is from the asset. In 5 years, you will always get the higher value, which means that now you will get immunized. Okay. Now you can actually explain using this one like this too. So Panel A, the first one showed that the initial balance sheet value, insurance company's GIC. The both asset obligation $10,000 because it doesn't change, right? So it matches. So plan fully funded. Plan B and C table show that, well, the B decrease, C increases. And if interest rate increases, it means that you basically gonna get the higher value because the bond price higher. So for asset side is $10,476.65. And for the liability size, the coupon bond, and then zero coupon bond, you're gonna get 10,476.11, which means your asset is greater than liability, so you can cover it again. Interest rate rise 9%, so the both bonds declines, right? The zero coupon bond value is 9,551. Liability, the coupon bond asset 9,549. So always the asset side, asset side is coupon, liability side is the zero coupon bond, and the value of asset is greater than liability or same, which means that you are fully insured. Okay, so it doesn't matter whether interest rate change, like the direction of interest rate does not really give you the risk, because if you get immunized like this, then you will get covered. You will get covered using the asset whose duration is same as the zero coupon guaranteed contract. So again, immunizations, you see the solid line is the coupon bond values, and the dotted line is single payment obligation, zero coupon bond value. And you clearly see that the coupon bond value is always greater. And in fact, if you remember the very first part, the relation between the coupon bond and zero coupon bond. So if the coupon is higher, it means that so single payment obligation, it's a zero coupon bond, right? Zero coupon bond, basically the value itself is kind of the flatter, and the coupon bond for whose duration is the same. So it's not basically the same maturity. The duration is the same. Then your coupon bond value is always higher. So any cases you can get covered. Doesn't matter whether the interest rate is increase or decreases, right? So your coupon bond value is always higher, means that you can get covered. So this is another example. The insurance company must make a payment $19,487 in 7 years. The market rate is 10%. So the present value of this obligation, $10,000. Okay. The company's portfolio manager wished to fund this obligation using 3-year zero coupon bonds and the perpetuity. So it's kind of, we simplify the examples. How can man immunize the obligation? So we basically try to find the weight in each. So weight of zero coupon bond and the weight of perpetuity to make this portfolio's duration equals to what? 7 years. Because this one payments basically is the zero coupon bond that pays 19,487 and sells for 10,000 today with yield is 10%. So let's look at that. So first calculate the duration of the liability. Easy, the zero coupon bond liability is equal to what? Equal to the maturity, which is 7 years. So we basically try to find the duration equal to 7, right? Now calculate the duration of asset portfolio. Now, the one is the zero coupon bond, 3-year maturities, right? So 3-year maturity, zero coupon bond, the duration. So zero coupon bond, the duration equal to 3. And duration of perpetuity is simply 1 plus y divided by y, because it's 10%, 11 years. So now, if the W is the weight on zeros, then what you can do is W times 3 years, which is 0 coupon, and 1 minus W, which is the weight on the perpetuity, times 11 years, duration of perpetuity. So if you solve this one, then you basically can find the solution. The solution is W should be 0.5. So weight of zero should be 50%, and the weight of perpetuity should be 50%. To get fully funded, what you should do is now you basically have the present value equals to $10,000, right? So you must purchase 5,000 zero coupon bond and 5,000 perpetuity, right? And for 5,000 zero coupon bond, the face value is 5,000 times 1 plus 10% to the third, because they have 3 years zero coupon bond. So $6,655 face value zero coupon bond. So that's one, that's first step. Now, what if time changes, like time passed? Still same? Probably not. Let's look at that. So we have same example. Now, 1 year passed. Now the present value of this obligation grown to 11,000 because 10% yield. So your $10,000 present value obligation increased by 10% 1 year, become $11,000, right? So we need to have 11,000 present value, so zeros and perpetuity first of all. Now, if you just keep having same portfolio, so 5,000 zero and 5,000 perpetuity, still same, 5,000 zero become 5,500 and 5,000 perpetuity become 5,500. So it's 11,000, so it matches. It looks like it's good. Looks is good. The problem is whether this portfolio's duration is same as the duration of our obligation again. Now the due duration we have is 6 years, right? 6 years. So we need to have the portfolio duration 6 years. Now duration of the zero coupon bond become 2, right? Because it's 2 years left. And duration of the perpetual is still 11. It never changes. Now we have same equation. So W is a zero coupon weight, and 2 is the zero coupon bond duration. 1 minus W is the perpetuity weight times 11 is perpetuity duration. If you solve this, then the solution is not half, it's actually 5/9, 5/9. Means that you actually have to increase zero coupon bond, $11,000 times 5/9, which is $6,111.11 zero coupon bonds. So what you have to do is, this require you basically have to reinvest this 500 coupon payment into zero, an additional $111.11 of the perpetuity sold, and again to the zero coupon bond. This is called rebalancing. So it means that multi-period immunization, you have to keep changing the portfolio weight because the duration keep changing. Each security duration changes, right? You're probably not gonna find exact asset that matches the obligation duration, just one asset. So you have to make portfolio. The problem is each security in the portfolio also have changes the duration over time. So you keep changing the weight to match the portfolio duration equals to the obligation duration. It's called a rebalancing. So the rebalancing is the realigning proportion of asset in portfolio as needed. So it's not easy, actually. It's not easy. Some people may ask me, ask you, well, what if? Just buying zero coupon bond with face value, same as the projected cash flow. This is called a cash flow matching. Exactly same fixed cash flow using the zero coupon bond. Looks right, sounds right, right? Because it automatically immunizes the portfolios from the interest rate risk because the cash flow from the bond and the obligation exactly offset each other. So cash flow matching on the multi-period basis is called the dedication strategy. In this case, the manager select either zero coupon or coupon bond with total cash flow same as a series of obligation. The advantage is it's basically once and for all approach to eliminate all interest rate risk. If the cash flow match it, then you don't need to have rebalancing because it automatically match every cash flows. But this cash flow matching is not widely pursued. There is a reason. Because you cannot select right bonds. Immunization, dedication strategies are appealing to the firms that do not wish to bet on general movement in interest rate, but these firms may want to immunize using bonds they believe are undervalued, right? Because if it is undervalued, the good thing is now you can make money. So when you find a bond that can be used as immunization, may be the one that whose value is undervalued. If you just pursue the cash flow matching, then impossible pursue this. So using underpriced bond is impossible. So that's one problem. Sometimes cash flow matching is impossible actually, because it's very hard to find exact bonds that match this cash flow. So that's why cash flow matching dedication strategies are not widely pursued. So that's the end of the part 3 about immunizations.